Here we go again, another interest rate rise.
The RBA has again increased its interest rates by 25 basis points.
Damn, my mortgage repayments are going to increase again. Think, Ray, think. What's better? Should I keep investing or start overpaying my mortgage? I don't know what to do. Yep, if you have a mortgage right now, you're probably thinking similar thoughts. The Reserve Bank of Australia over the past year have rapidly increased interest rates to the point where mortgage rates are through the roof, which means that you now get a higher effective rate of return when you overpay your mortgage compared to previously. But unfortunately, it's not that simple, because choosing whether or not to overpay your mortgage or to continue to invest in the stock market is probably one of the most complex financial decisions that we'll ever have to make in our lives. There are just so many different factors at play, and making the wrong decision could cost you thousands, if not tens of thousands of dollars. But in this video, we'll hopefully get to the bottom of this huge dilemma that most of us are probably dealing with. So let's get started with the problem at hand. So if you look back just 2 years ago, mortgage interest rates could be found for as low as 1.89%. So having a $700,000 mortgage back then over a 30-year term meant that your monthly repayments would be $2,549. And in total, over the life of the loan, we'd be paying back the bank around $950,000. And if you decided to overpay your mortgage by $500 each month, you'd save just under $48,000 in interest over the life of the loan, and you'd finish repaying your mortgage 6 years and 2 months earlier. But because the Reserve Bank has been hiking interest rates, mortgage rates nowadays can be found for around about 5.5%. Now, if we run those exact same numbers as before, except this time with a 5.5% interest rate, our mortgage repayments become $3,975, which is an extra $1,500 each and every month. And in total, you'd be paying back a staggering $1.43 million to the bank in total. And this means that a $500 overpayment each and every month is instead going to save you $195,000, and you'd finish repaying the mortgage in 7 years instead of 6 years and 2 months. So we've now confirmed that by overpaying our mortgage, we're going to be paying significantly less interest over the life of the loan. However, we still need to understand how this compares to investing our money into the stock market. So let's assume that we took that $500 overpayment and then instead invested that into the stock market at an average return of 8% per year over 23 years, which is the total length of the reduced mortgage. And this would earn us just around $243,000 in interest. Now, just by looking at these numbers and then comparing that to the example of overpaying our mortgage, it's obviously clear that we're better off investing our money. But this is where most people get it wrong, because we can't just take these two scenarios and then compare them side by side. Because in the example where we're overpaying our mortgage, after 23 years, we're left with no debt at all. However, in the example where we're investing into the stock market, after 23 years, we still have 7 years left on our mortgage that we have to pay off. So for us to make these calculations properly, we need to compare both scenarios over a 30-year time period and look at not only the investment returns, but also the difference in the interest paid as well. So if we look back at the investment scenario, if we instead invested $500 a month for 30 years, by the end of it, we would have made just under $530,000. But we'd also have to account for the additional interest that we need to pay on our mortgage over the next 7 years. And this is the $195,000 in interest that we didn't save from overpaying our mortgage, which gives us a total amount of just under $320,000. And in the scenario where we're overpaying our mortgage, in the first 23 years, we aren't investing at all due to the fact that we're overpaying our mortgage. We do end up saving the $195,000 in interest along the way. And once we've paid off our mortgage, this is when we can begin investing into the stock market. Except we have significantly more money to now invest into the stock market because we no longer have to worry about our mortgage repayments. So instead of just investing $500 each month, we now have $4,475 each month to invest into the stock market, which after 7 years would given us a total return of $124,000. So to finally compare both scenarios over 30 years, in the first scenario where we are overpaying our mortgage, we would have saved $195,000 in interest and made $123,000 in the stock market, giving us a total of $320,000. Whilst in the second scenario, we make $529,000 in the stock market, but have to pay an additional $195,000 in interest, giving us a grand total of just under $333,000. So after 30 years, the maths is telling us that we do end up ahead when we invest our money into the stock market, but only by the slightest of margins. Now, obviously we made a lot of assumptions here. So if the interest rate changes or the expected stock market return changes, obviously this will change the overall results. So with the maths out of the way, let's look at some of the other pros and cons to overpaying your mortgage. Starting with the fact that by overpaying your mortgage, you're getting a guaranteed return on your money. If you came to me with an investment opportunity where I can make a guaranteed return of 5.5% on my money, I'd be thinking whether or not it was some kind of scam. In the example just now, we assumed that we'd be making 8% in the stock market each and every year for 30 years. And whilst based on historical averages adjusting for inflation, I think that's a pretty reasonable assumption. However, we all know how volatile the stock market can be. And based on projections done by Vanguard themselves, they're expecting both the Australian and international equities market to grow well below 8% over the next 10 years. Now, these are only forecasts, so take it with a grain of salt because they could be wrong, but they could also be right. Even the slightest of decreases to the expected rate of return of the stock market and the scenario where we're overpaying our mortgage becomes more and more attractive. For example, if we assumed a more conservative 7% return in the stock market, then after 30 years, our money would have grown to just over $400,000. And once we take away the extra interest that we'd still owe on our mortgage, then when we compare that to the scenario of overpaying our mortgage, that becomes much more attractive. Another benefit to overpaying your mortgage is that at a later date, you can refinance your mortgage and get a lower interest rate because you now have more equity in your home and you're deemed as a lower risk to the banks. Currently, some of the best interest rates on the market require your leverage to be lower than 70%. So the faster that we pay down our mortgage, the quicker we get access to those lower interest rates. And finally, we have the psychological benefits of getting yourself to the point where you're mortgage free. This will create for many a great sense of freedom that is hard to equate in value. Personally, for me, I would much rather be mortgage free than make some extra money in the stock market. So there are definitely a lot of pros towards overpaying your mortgage, but there's also some cons as well. Starting with the fact that overpaying your mortgage is never going to be the best return for your money. It's still widely regarded that even at high interest rates, investing your money into the stock market over the long term will provide you with a greater overall return on your money. The Reserve Bank has now kept the cash rate constant at 4.1% for 2 quarters now. And whilst I think it's important to acknowledge that we're probably never going to go back to the ultra low interest rate environment that we were in previously, I think that it is quite possible that interest rates have reached its peak. The main driver behind the Reserve Bank hiking interest rates so quickly was because inflation was spiraling out of control. But inflation is slowing down now, and we've had 2 consecutive quarters where inflation has decreased. And if this trend were to continue, then there's no driver for the Reserve Bank to increase interest rates anymore. And once inflation comes back down to that 2 to 3% mark, who knows, the Reserve Bank might even begin loosening interest rates. And if this were to happen, then overpaying our mortgage would become less and less attractive, and instead investing our money into the stock market becomes more and more attractive. And on top of that, the more time that we have our money invested into the stock market, the better, due to compound interest. And the term compound interest refers to the interest that you earn on your own interest. Now, I know that sounds a little bit complex, so let me explain that to you with a simple example. So let's say you invested $1,000 and you get a 10% return. Now, at the end of the year, you're going to have $1,100. Now, when you start the next year, if you get another 10% return, then you'll end up with $1,210. And now pretend that this pattern continues for another 20 years, your money will continue to earn money on the previous balance every single year. So that at the end of year 20, you're gonna have $6,727. So by consistently investing $500 into the stock market and then getting a consistent return year after year, your money is going to grow to the point that you become a millionaire. Now, time is also not just beneficial when it comes to investing. It's also beneficial in devaluing the value of your debt. The basic rule of inflation is that it causes the value of your currency to decline over time. In other words, cash now is worth more than cash in the future, which means that inflation essentially lets people with mortgages pay the banks back with money that's worth less in the future. Just like how the price of milk isn't what it was a few years ago, your $750,000 mortgage today won't be worth $750,000 when you finally pay it off 10 to 20 years from now. Now, the next point might be a little bit controversial, but it's the fact that your house is actually a liability. Now, hear me out here. Most people in Australia will have the majority of their net worth tied up in their property. Now, the issue with this is that with a house, whilst you live in it, it's actually not an income generating asset. What that means is that if you were to lose your job, you can't rely on that house to pay for your bills. In fact, it's the opposite. It's going to continue costing you money to manage and maintain and continue making your monthly mortgage repayments. Even if you've paid it off completely, there's still going to be ongoing maintenance costs, council tax, and land tax as well. The concept of overpaying your mortgage may leave you overexposed to property relative to your other assets, when really what might be more beneficial is to focus on building a portfolio of income producing assets that can support you if you ever were to lose your job. It's also just good practice at the end of the day to diversify your money across several different assets so that you aren't overexposed to one single asset. And finally, the last point, which I think is quite important, is that the impact of overpaying your mortgage might not be as big as you think. Let's just assume that your biggest concern isn't actually the best return on your money, but the fact that you won't be able to meet your mortgage repayments when you refinance your mortgage on a higher interest rate. Now, realistically, if that were your main concern, overpaying your mortgage by $500 each month isn't really going to make that much of a difference at the end of the day. Even if you overpaid your mortgage by $20,000 each year, it's not really going to make that big of a dent on your monthly repayments. It might reduce it by $100 to $200, but in the grand scheme of things, it's not that much. Now, I did want to give a definitive answer at the end of this video, but I think we all know the truth that there just isn't one. For me personally, I think that if you've got a long time left on your mortgage, a mortgage at the end of the day represents some of the cheapest debt that you'll ever get in your entire life. Even at higher interest rates, with inflation and the appreciation in the value of a home, over time, this will diminish the impact of that mortgage on your finances. But I can also appreciate that someone near the end of their mortgage might just sit there and go, well, this guaranteed return of 5.5% is definitely better than what I might get in the stock market in the next 1 to 2 years. So I may as well just overpay my mortgage. And finally, there's definitely a lot of people out there that will value the freedom of being mortgage free over the potential risk and return of investing their money into the stock market. Now, with all that being said, I do think that there is an alternative situation that provides us the best of both worlds. Instead of actually overpaying your mortgage, simply just park all of your extra money into the offset account. It effectively is the same as overpaying your mortgage, except you have a lot more flexibility with the money because you can choose to take out that money and then use it however you want. So if in a year or two, inflation comes under control and interest rates start to fall, then you can take that money out and then invest it into the stock market or any other investment opportunity that comes to mind. Or in the worst case scenario, you lose your job, then you can use the money in your offset account to continue making mortgage repayments so you don't go into arrears. Now, another common question that gets asked is whether or not we should be paying down our HECS debt sooner with inflation being so high. So make sure to check out this video right here if you want to know the answer.